Greetings and welcome to another edition of After Hours with Pastor Joe.
And Lady Lynnette. Good
The
evening,
Quiet
everybody.
Storm. Dear, this is our third week.
I know.
Every Sunday.
Every Sunday. This is fun spending Sunday night with our people.
Yeah. Salute to the Salem Bible Church family.
Salute.
Atlanta Stonecrest.
We love you.
Yeah. It's been great. And we've been basically using each evening on Sundays.
Yes.
In the month of May.
Mm-hmm.
We're launching a program called Give, Save, Live, to where the initiative is not only, or the call to action is not just for people to tithe 10%, but to save 10%.
Yes.
And to live off of the 80.
Yes,
And
I love that.
good fundamentals that pretty much all of us need.
Yes.
So we've taken this as an opportunity to take different elements of finances, the messages, and just to really talk about it. And we're going to talk about an important one.
Yeah. So make sure you guys comment. Make sure you guys ask questions and engage, because we do read the questions.
We do read them. So we're talking about insurance.
Yes. We don't talk enough about insurance.
And specifically, if it goes into different, branches and areas, is cool. But specifically, we're talking about life insurance.
You hate to really talk about it.
You really hate. Go ahead.
I think it's one of those topics that you just really don't like to talk about, but it's such a necessity, especially where the world is now. Tomorrow not being promised, the economy. You have to talk about insurance. So.
And to your point, a lot of people don't want to talk about it because it makes you think about your own mortality, or the mortality of your spouse.
Yeah.
The mortality of your parents.
Yeah.
Or even your children in certain. It's horrible.
It's unfathomable.
And a lot of times we live life not wanting to deal with things that we really need to deal with. And let me tell you, the only thing worse than dealing with it is if something happens and you haven't dealt with it.
That is the truth.
Being in ministry, this would be 27 years for me. Isn't that crazy?
It's wild.
No, 27 years. And being in church all of my life, I've seen so many people die with nothing. I've seen so many times a husband died and the family had nothing. House was gone. Cars was gone. Because they didn't want to talk about it. So this may not be a sexy,
conversation. Yeah.
But it's a needed conversation. We aren't experts. The whole platform of this particular segment is not to say or act like we're experts on everything, but to tell you what we know about it and what we did and have done, and maybe what we need to do.
Absolutely.
Because there may be elements in our conversation that we haven't covered. So we're going to talk about the two major forms of insurance. Okay.
Yes.
You got whole life insurance and you got term insurance.
Yes.
And both of them have pros and they have cons. So the definition of insurance is, okay, so before we even get to that, let's talk about why a person needs insurance. Life insurance, whether it's whole or term, is designed to do one thing, and that's replace income. So if you're a person that you're watching this, if you're a wife, if you're a husband, if you're a single parent, the first question you want to ask yourself is, if I, in the event of my untimely demise or timely demise, maybe you live out, a good, long, healthy life.
Good point.
The question is, when you pass away, all right, how much money does your family need to replace whatever will be lost once you are no longer on this planet?
Correct.
That's the most simplistic way to say, am I overinsured? Am I underinsured? Do I have enough? So that's the first thing you have to ask yourself. So if you're a person and you are a man, and let's say, for instance, you make $150,000 a year. Let's say that, right? And let's say, for instance, you're married to someone and your wife makes $75,000 a year. Or let's say she makes $150,000 a year. Let's just say they both make $150,000.
Okay.
If something happens to the man, you have to ask yourself, how much money do I need to replace my income? And how long do I need to replace it? So it's going to be different from Douglas than it is from Michael, than it is from Juanita, than it is going to be from Michelle. because they may be at different ages. They may have different savings.
Yep.
Maybe one is a young couple.
Mm-hmm.
Maybe the other is a couple who, you got 10 more years to retirement. So the first place that you need to understand is you need to understand that life insurance is designed to replace income.
Yeah. And these are the conversations, as you just kind of led into the start of it. These are the types of questions you literally need to write down and have conversations with, not just haphazardly as you all walk out the door or on the phone call about to get off, but sit down with your family member, sit down with your spouse, sit down with your children and say, and have this conversation.
Yeah. Have this conversation. It's very important.
Yeah.
So,
I'm talking about replacing income.
Yeah. Replacing income. So let's talk about pros and cons.
Okay.
To both. Because a lot of people say, okay, life insurance replaces income. And you really need to understand that, because a person, let's say, for instance, you have a substantial savings in your 401k investment, and you're trying to get insurance. You need to keep that in mind, because you still have that.
Right.
And life insurance is to replace income. All right. So you hear term insurance and you hear whole life. Term insurance is exactly what it says. It covers you for a term.
Specific amount of time.
10 years, 20 years, 30 years. So if your untimely demise is within the limits of that term, then you will receive, or your beneficiaries will receive, basically the money from that insurance policy.
Payout, basically.
Right. So basically what the insurance company is doing is the insurance company is betting.
Yeah.
I hate to say it.
I mean, yeah.
The insurance company is betting on, look at it either way, on the likelihood of your death.
Yeah. Your life expectancy on average.
And that's how it determines premiums.
Yeah.
And we're going to get back to that.
Yeah.
Okay. All right. So that's term life insurance. The other is whole life insurance. The difference between term and whole life insurance is basically designed to cover the whole life. It's not for a term. Mostly it's as long as you're making payments to the premium that you're able to do that. So before we get into the nitty gritty, let's tell them about our story.
Okay.
Do you even remember?
Maybe.
So
where would you like
Lynnette
to start?
and I got married October 21st.
Yes.
2016.
Yes.
We are approaching 9 years.
Oh, been such a
glorious years.
Glorious, babe.
High five, babe.
High five,
it's been
babe.
Awesome. Greatest thing I did next to coming to Jesus.
You better have said that.
It's been great.
Yeah.
And we got married on a Friday. We went to church on that Sunday.
Yes.
Announced it.
Yes.
Some people are still shocked.
Second greatest day.
Second greatest day. And then on Monday morning, we went to the insurance company.
I do remember that.
Remember that?
I do remember that.
First thing we did.
Yeah. I was trying
before
to move.
We went on a honeymoon.
Yep.
Before we bought a house together.
Yep. And you led that. You said, Lynnette, tomorrow, Sunday after church, you said, Lynnette, tomorrow we're going to see the lawyers.
Right. And that's what we did.
And that's exactly what we did.
We got insurance on day 3. All right. And because like you really can't take any chances as it relates to that, so that was the first thing that we did.
Wow.
And that was a good move. And we had many of these conversations there. So let's talk about term insurance and let's talk about whole life, what the difference is. Term, of course, is a term. 10, 20, 30 makes sense. Whole life it covers the entire life. All right. Now, the biggest pro to term life insurance is it's more inexpensive.
Correct.
So it's going to be a lot cheaper. Okay.
Because it's for a term.
Right.
So
whole life insurance is going to be more pricey. The premiums are going to be more expensive. And what they tell you with whole life insurance is the insurance policy will accrue what's called a cash value. So let's say, for instance, you got $1 million policy. And after 10 years, you got $150,000 cash value. That cash value is your money to a certain degree. It is tax-free, but it's not as black and white. So the question that a lot of people may be asking is, do I need term or do I need whole? You got any thoughts? What do you think?
I think I think you just said it. When you ask yourself, when you sit down with your family and say, do I need term or do I need whole? You really need to have this conversation with a professional. You want to talk with your family about what your needs are, what your family needs are, what your income replacement needs would be if said events were to transpire. But then you need to take those conversations with your family and take it to a professional to say, hey, look, these are our goals. This is what we plan to do. This is the amount of money that we can contribute per month over the course of X amount of time or for our lifetime. What are our best options?
Yeah.
And that will help determine. Now, you don't necessarily have to do exactly what the professional says, but you can kind of take into account. You really want to educate yourself on your family's needs, and it varies from family to family.
Yes, absolutely. A couple of suggestions, and I want to talk about this. I think that the best plan of action for young families is term insurance. Because if you're a young family, meaning that you're under the age of 30, you're starting your family, husband, wife, maybe small children or no children, maybe you have future children. Term life is a great way to start, because what it does is going to give your family immediate coverage at the lowest possible rate. If you are a young family out there and you're watching this, you're a young husband, you're a young wife, get you some term insurance now. Now, one of the reasons why you want to do that is because a lot of younger families haven't lived long enough to accrue the 401k, the retirement accounts, to where you can leave your wife, your husband, your children X amount of dollars to cover the house, to cover funeral arrangements or things that none of us want to talk about, but of course we need to talk about. But another pro to getting life insurance at a young age is many of the insurance policies require a physical.
You're absolutely right.
Why? Because the insurance company, remember, Lynnette, is betting on when you're going to keel over.
And the healthier you are, the less likely, the higher premiums that you will receive, because they figure a healthy person.
Lower chances
of mortality.
Exactly. Makes sense.
Now,
guess what some of the metrics that they look for?
Go.
BMI.
Body mass index. Height over weight.
So if you're obese, you're going to have a higher premium, because the insurance company is saying you're going to be more likely to die early. What else? Blood pressure. What else? Waist circumference. What else? If you have any type of morbidities, high cholesterol, metabolic or metabolic issues, or diabetes.
Do they still ask you about smoking? Because I feel like smoking used to be one of them.
Because that increases likelihood of cancer. A lot of them will have HIV tests. So getting the blood test is allowing the insurance company to know how to gamble, because premiums are always based on likelihood of one versus something else happening. So the younger you are, the higher the chances you're going to have fewer comorbidities, maybe you're going to be a little lighter, and you can lock in those rates. All right. So what do you think about that?
That is game, because no one is going to tell you that. No one is going to, because you think when you're young, you're healthy, you don't need it. But by the time you get to a place in your life where you're starting your family, or, you have an unexpected health issue and you try to get insurance, you get denied, or your premiums are so high that you literally can't afford it. Hence why you should get it early.
Right. Get it early. Now, and that's going to be for both term and sometimes there's certain companies that don't require it. But if you're getting whole life insurance, if you're getting something that's substantial, they're going to test you, because they have to be certain that they're not insuring someone who's going to die tomorrow.
And that you don't have any pre-existing conditions.
Right.
So
that befuddle
Mm-hmm.
the
payout.
statistics.
Yep.
Okay, so it's very important for people to understand. So if you're a young family, you want to get you some good term life insurance. You want to say, all right, how much income do we need to replace in the event of my demise? So if a man is making $100,000 a year and he's got 30 more years to he retires, so that's $3 million north of that, right? Probably $3.5 million. So if you're trying, if you know that you're going to be working for another 30 years, you need to be covering your salary for the next 30 years. Let's say, for instance, you're 15 years away from retirement. You need to be covering 15 years of your salary, because remember, the insurance face value that you get needs to cover how much income your household loses.
Correct.
And that's why it's a sliding scale. It's really how much money you have saved, how much cash, because when individuals like Arthur Blank and Bill Gates, they don't have life insurance.
Correct. Because they got money.
They got money.
They got money. Yeah.
At the end of the day.
Yeah.
So they don't need insurance vehicles to replace income.
We do.
Okay. Yeah. Normal Americans.
Yeah.
Hardworking people like us and most of you, we would imagine, who are watching. This is what you need. Now, let's talk about whole life, because a lot of people don't understand that there are different elements of whole life insurance that bring up things that you can do that you can't do with term. And that is you can't accrue cash value. So let's say, for instance, I got $1 million policy on my life, right? I got $1 million policy. And after 7 years, I've got $150,000 of cash that's built. I can withdraw that money. And when I withdraw that money, I can essentially use that money to fund whatever project I want.
Okay.
So a whole life insurance policy allows you to become your own bank.
So it's basically you can borrow against yourself.
You can borrow against yourself.
Okay. Can I ask you a question?
Yeah, shoot.
Are there, and I know this probably depends, but generally, are there stipulations on if you take the money, do you have to replace it in a certain amount of time? Are there certain stipulations on what you can use that money for? Things like that.
That's a great question. In most instances, that money is tax-free. So when you take that money out, you are not taxed on, let's say, for instance, you got a whole life insurance policy that you paid into religiously. Maybe it comes out of your budget. You don't even see it. You don't even feel it's good. And you want to do some, you want to renovate your kitchen that costs 50 grand, new cabinets, new floors, whatever it is. Instead of going to a bank and you're opening up a line of credit to where you have a certain interest rate that you have to pay back, you can essentially take the money and pull it out and take the cash value out and pay yourself back.
Understood.
Now, this is the problem that a lot of people get into. When you take money out of your insurance policy, that whoever the carrier is of that particular insurance is going to tack fees onto that money.
That's the gotcha.
That's the gotcha. So if you don't pay it back, the fees will erode the cash value. That's the trick.
Because they're going to get their money.
They're going to get their money.
Yeah. Okay.
So yeah, you got this. You got this cash value, this $100,000 that's built up cash value, or $200,000 that's built up cash value. But if you take money out of it, you have to pay it back. And if you don't, you're going to have fees. And what's going to happen is, if I got $1 million policy and I've got let's say, for instance, I got $150,000 cash value, and I take the money out and I don't pay it back, that cash value is subtracted from the face of the policy.
Oh, yeah.
Now, one has to ask oneself,
yes,
is it really worth it to buy a whole life? Now, one of the things you want to look for, because Lynnette gave I think you gave them a great suggestion about talking to a professional. But we also have to remember, because the beauty of us having this conversation is we telling them what we did and what we know. What you all have to understand is you want to talk to the professionals, as Lynnette said, but you also want to remember that the professionals that you're talking to are salesmen and
Correct.
saleswomen.
Correct.
You got to remember, if they're writing up your insurance, they're getting a commission. And a lot of the individuals who sell whole life insurance are going to dangle the carrot of you'll be able to have your own cash value.
Mm-hmm.
You'll be able to have this.
You'll
be able to have
pull
that.
From it.
You'll be able to pull from it. But they're not going to, in many instances, go into details about what we just told you.
Yes.
And a lot of times you can be in a more messed up situation with that. So the question is this: do we really need whole life insurance? It depends. A lot of people are watching this may not have the discipline or the wherewithal or even the desire to look at other investments. However, I do personally believe that people will be better saving money with term insurance to cover you while taking money and instead of having whole life, making good, solid investments. Because when you make good, solid investments, your money is your money. You got capital gains tax. We can't get around that at the end of the day. But what I'm trying to say is we can probably save more money by making a $600 to $700 investment in the stock market over the course of 30 years than we can with an insurance vehicle.
That's very true.
That's what I'm saying.
And I think it bodes to the sermons that we've had over the last couple of weeks. And this conversation really builds upon the debt strategy, the tithing, the savings, and honoring God through all of that. And knowing what expenses you have going out, coming in, because that's how you're going to determine if you can afford the term policy versus the whole and all that jazz. So
right.
I love this conversation.
Yeah, it is. So that's excuse me. So that's what people have to really kind of know and understand. You got term and you got whole life. I personally believe good, solid investing in the stock market with term insurance is the best way to go.
Yeah, I mean, and I also agree, and I think that the way the economy is right now, really staying plugged into your family's needs, and it may change, right? So you may have this plan of a 20-year term, and halfway through your family dynamics change, health changes, and you may want to switch over to whole. That's absolutely within your right to do that. But you just have to make certain that you have a trusted professional that you can bounce things off of, and an organization that's really going to help navigate you through those changes.
Right. Now, being that we've got a few more minutes left, let's talk about other types of insurance that people may need. Like number one, let's talk about medical insurance.
Okay.
Which has been a dismal conversation in the U.S. I remember when I was a kid growing up, getting a doctor, getting care was so much easier than it is now.
Yeah. Now everybody's out of network.
When President Obama came in and worked on Obamacare, I think that, and I'm just going to be 100% honest, I think that the thought of providing insurance for every American is a great thing. But I don't think it was done correctly. I think a lot of the problems, I think that the state of healthcare and insurance wasn't really thought through like it should have.
Yeah, the long term wasn't,
because we don't have access to the care that we once did.
Correct.
Doctors don't have the freedoms to treat their patients as they once did.
Correct.
Doctors can't make the dollars that they need to make to justify going to medical school, which is one of the reasons why there are fewer and fewer physicians. A lot of people are becoming physician assistants.
Correct.
Because you don't have to go to school as long. You don't have to go in as much debt, and you can almost make just as much money in certain situations, not every situation.
Right.
So the healthcare in this country is really, really jacked up. We have, do you think it's wise that people search for, what are some of the things that you found? Because having small kids, needing inhalers, they always go through those stages of Tell them some of the things that you found.
So one of the things that we found, number one, is we research companies every single year. And you hate to, I mean, it's a pain to kind of change policies and update forms and things like that. But we have a certain amount or certain practitioners that we have come to trust and love within our family. So we always want to make certain that they are in network for whatever, but these premiums, they can get really pricey for a family of 4. So if you're a single person, when I was single, my premium was, I could pocket change. I could, I can pay that out of pocket. But when you are talking about a family of 4, to your
$1,100 a month is how much our health insurance is.
Yeah.
$1,100.
And it went down from last year. Isn't that crazy? Yeah. But when you look at the insurance companies, to your point, what you were just talking about with term versus whole, and they're kind of gauging, the medical industry does the same thing. They're saying, okay, well, a family of 4 is going to be a lot pricier than a family of 2. And so how many times are they going to go to the doctor every year? How many times are they going to need to see a specialist? Just transparently, a really quick story. We had to take our oldest to the emergency room maybe like a month or so ago. Praise God, she was fine. It was a quick visit. We were literally there maybe 3 hours. The bill was $5,000. And so you think about the premium that we pay. Of course, you're going to pay it, but you think about how many families can't do that. So to your specific question, number one, we research insurance companies every year. The second thing that we do is make certain that the providers that we've come to trust are in network, so you don't have to pay those out-of-pocket costs. 3, you read the terms of specific medical insurance companies, because a lot of them do automatically include minor children with vision and dental. So you don't have to buy separate policies for that. And so that was something that we wanted to make certain. So our vision and dental is not included in our medical policy, but because we have minor children and are considered dependents under the primary account holder, they are covered for dental and vision. So you got to make certain about what your needs are. Specialists are
keep going.
Okay. Specialists are something totally different. So when I was in my OBGYN era of having to go to gynecologists and obstetrics, I don't have that right now. So that wasn't something that I was looking for in a policy. So now I just need a primary care physician. When the children were super young and they were, in the thick of like vaccines and colds and subsequently developing asthma, we needed to then make certain that allergists were a part of the realm of specialty that we could have. So anyway, so you got to know your family's needs. And so looking at insurance policies and making certain that you research them every year, because the same policy and the same coverage, just like with car insurance, but the same policy that we had last year, we have this year, but the premium is a little bit lower. So
that's excellent. One more type of insurance that I would like for us to cover that I think is worth covering is long-term health insurance, in terms of individuals who, long-term health insurance, as we know, is a type of health insurance that kicks in when you get to the point of a certain age and you can no longer care for yourself or you need assistance.
Yes.
And this is a very, very, very serious conversation, because there are a lot of people in America who are struggling with dementia, Alzheimer's, and there's a lot of caretakers out there. You're caring for your mother, you're caring for your father, you're caring for a spouse. This is where pre-planning for all of us can help our caretakers. Now, most of the caretakers that I know who are caring for individuals who have dementia or Alzheimer's, they don't have this type of insurance. But when you get a good long-term health insurance, like what we're talking about, it provides a litany of different things when you need it. It can be individuals who come to the house and clean. It can be individuals who come to the house and sit with you. It can be used to divert cost of certain type of assisted living facilities, memory care facilities, a laundry list of different things. So individuals, when you start to approach 50, this is the time when that conversation needs to be had for men and women. Now, I've got some numbers, and I just want to share this with you. A 55-year-old male might pay around $1,750 annually for a policy with a $165,000 benefit.
Okay.
While a 55-year-old female might pay around $2,800.
Wow.
And why is it that women will pay more? You know why?
I don't.
Because y'all live longer.
We do. Okay.
And dementia and Alzheimer's statistically impacts women more than men. Yeah. All of those are the types of things that impact premium.
Can I ask you a question?
Sure.
So I think long-term health insurance is a great conversation. So when we think about typical term and whole, we're trying to replace income.
Yes.
But with long-term health insurance, we're not only attempting to replace income, but we're attempting to divert the cost of said extra services that are needed to sustain the quality of life of said person.
Right. I think long-term health insurance helps to preserve resources for your beneficiaries.
Got it.
That would be what I would, let's say, for instance, I was a school teacher, or I worked for the city, or I had my own business, or whatever I did. And I got to the point to where I retired. So I've got my retirement account and I'm getting income each month that I'm living off of. All right. What long-term health insurance is going to do, if I get to the point to where I need help, that $165,000 policy or $200,000 policy will help to care for me while preserving what I have. So when I transition, when I pass away, I don't have to spend my money, and there can be generational wealth instead of basically going, because medical issues and medical care late in life will erode wealth quicker than anything.
Yep.
And a lot of times when you go to these assisted living facilities, they'll tell you, you give us your money.
Isn't that wild?
They take your money and they care for these people until they transition, and you never know how. And the other option is to basically private pay, to where you're paying monthly,
which is egregious.
So when you have this type of insurance, it can be a peace of mind that if your children have to care for you, they got money to help.
To be able to,
to where if they need to find a place for you, they can. Or if because a lot of the different policies will allow the caretakers to decide how you spend the money. They don't tell you how to spend it. It's not like a grant.
Right.
They say, okay, we're going to give you $3,000 a month or $5,000 a month for the next 5 years. And basically you do with it what you want. That's what so these are conversations that I'm glad we're bringing up. So here at Salem Bible Church, we are looking forward to Give, Save, Live. All Tithe Day is going to be the first Sunday in June. And what the ask is on All Tithe Day is, when All Tithe Day comes, all of us are being committed to do what the word of the Lord tells us. And that's to bring the tithe into the storehouse. But also we're moving our people to the point where not only we give God 10%, but we get in the habit of saving 10%. And then we're going to live on the other 80%. And when all of the statistics have been researched, it says that by and large, most Christians who do not tithe because they're in some form of debt, credit card debt primarily. The average American is in about $7,600 worth of credit card debt. If you make minimum payments, you'll be in debt for almost 12 years. So what we're doing at Salem Bible Church, we're going to start to have different financial discussions. Speakers, some of them will be in person, some of them will be virtual, to teach us and to show us how can we manage our debt. And that's, you and I were talking about debt strategy, things like that. So we want you guys to join us. So let them know how they can stay in contact with us, how to get to us, all that stuff.
Yes. So you want to make certain to subscribe and bookmark exactly where you're watching this, which is our Salem Bible Church official YouTube page, but also www.salembiblechurch.org. That's where you can stay in contact with everything that's going on at either one of our two locations. So every single Sunday at 11 a.m. at our Salem Bible Church Atlanta, 2283 Baker Road location, or our Atlanta Stonecrest, which is 5460 Hillendale Road in Stonecrest. We have services every Sunday at 11 a.m. Please feel free to join us. We would love to see you. Also on our Instagram page, which is Salem Bible Church.
All right. Thank y'all for another After Hours. Hope you enjoyed it. And join us next week as we close the month out.
Oh, man, it went so fast.
So fast. You know what they say?
What do they say?
Time travels quickly when you're having fun. See you on the next one. Shalom.
Bye, guys.